There are still hopes that the Fed is going to cut interest rates again twice this year. But our guest says, as for guidance from Jay Powell yesterday, the guy looked like a shrugging emoji. He didn't give very much away. Let's get more from Blake Gwinn, head of U.S. rate strategy for RBC Capital Markets. You've been writing some good stuff. You say that Jay Powell was almost perfectly neutral, or that was your take.
Yeah, I mean, I kind of likened it to a goalie in soccer trying to defend against a penalty. I think the Fed right now, they don't know whether the risks are going to break towards the upside on inflation or break to the downside on growth. And, they can kind of flip a coin and choose one side to cover. But if they're wrong, they end up even more offsides and almost impossible to save the other direction. So I think the right way to play this is probably what they're doing, which is staying very neutral. Try to see if the data kind of tips its hand in the coming months before they really commit to defending either side of that mandate. So that's why I think we had Powell just talking very evenly about the risk to both sides of the mandate. And I think it was almost impossible to come out of that press conference and say that Powell was definitively dovish or definitively hawkish.
I mean, it's a particularly tough time, I guess, for him right now, because who knows where this trade war is going to go economically.
Yeah, and I mean, the way I see it, they really have three questions that they need to answer. One is, what does the trade policy look like over the next few months? How is that going to evolve? I think there's a second question about what are the impacts of that trade policy going to be? Is it going to be more upside inflation pressure or more downside growth risks? It's not really clear how that's going to break. And then I think the third thing is really around the uncertainty around policies itself. That uncertainty, and it's not just trade policies, there's uncertainty around a lot of the cuts that DOGE has been doing, for example, the stability, if you're a business that relies on government grants, government loans, or even just government infrastructure, airlines that rely on air traffic control. There's just a lot of uncertainty out there. And so I think that third question is, are we going to see that uncertainty, which has been clearly weighing on the survey data recently, the soft data, if you will? Are we going to start to see that leak over into weakness in the hard data? So until they really see how how the answers to those three questions are evolving, I think we're just in this kind of wait and see mode for the Fed. They're just not going to commit to either side.
Let's have a look at a 5-year chart for the U.S. 10-year bond yield. We have seen yields coming down. Do you think that's because investors are feeling more comfortable that inflation is going to be modest, or is it a flight to safety? Well,
if we're just talking about the reaction to yesterday, okay. I was actually a bit confused about the reaction to the FOMC. We did kind of treat the meeting as dovish. You saw, yields moving lower, particularly in the front end, which is kind of your classic dovish reaction. Maybe there was some expectation that the dots were going to go to, one cut for 2025, or that Powell was going to be a little bit more keyed in on inflation. And when that didn't happen, when he was more neutral, maybe that read as a bit dovish. But then I think you have the second piece, which is the broader decline in yields. And I think that, that's really happened over the last month or two. That I think is hand in hand with this narrative shift that, as we've gotten all this uncertainty on policies, it has frozen businesses, consumers, investors in their tracks. You kind of have this deer in headlights type of mentality. And so I think that's what's weighing on, sentiment. That's what's weighing on yields, weighing on risk assets. But I would say, I think at this point, really what we've seen is a pricing out of the optimism that really got built up after the election. So November, December, and into early January, when you saw this massive optimism on what the first year of the Trump administration was going to look like, that has unwound. I don't know that we've clearly tipped over into expecting a recession or anything like that. There's still much more that we could go in that direction. If we see that hard data, starting to show any signs of deterioration, there's more to go if that happens. Right now, I think what we've seen and what the reason yields have fallen over the last month is really the unwind of that optimism that we had coming out of the election.
Was Powell unwise to indicate that he thinks that inflationary impact of tariffs will be transitory? Because we do remember what happened in COVID. Central bankers in a lot of places said, this too will pass, but it turned out to be persistent.
I'm actually very glad you asked me that, because I am a massive Fed apologist. And admittedly, I spent a good part of my career at the Fed. So maybe I'm just kind of talking my book here. But I think the transitory thing has been vastly misunderstood. I think, transitory could mean a period of time, and I think a lot of people took that to mean this is going to be short. Whereas I think what the Fed was thinking was really, what are the drivers of that inflationary pressure we're seeing? If it's really just because supply chains are impacted due to COVID closures and those ports open back up and those supply chains open back up, will that inflation go away? So I think it was more about what was driving the inflation. Transitory is more about the factors that are causing it rather than a specific length of time. So, what happened back then? I mean, if you could have called the Omicron wave and that it would have shut down China again, if you could have called the Russia invasion of Ukraine that sent energy and food prices soaring, kudos to you. But I don't think the Fed, when they were saying transitory, really knew that those things were on the horizon. And so, they were kind of hit by these exogenous factors that caused that inflation to extend and to last longer than expected. And I don't really fault them for that. I really think when they said transitory, I look at the factors that are driving it. And when I look at this inflation, if we are talking about tariffs, then I think it is fair to say it's transitory, because if those tariffs were lifted, presumably that inflationary pressure would go away. And that's really what I think, when I think of transitory, that's really more what I'm thinking about than say, oh, it's going to last 3 months or 4 months or something like that.
Thanks very much. Yeah, you gave us some context there. A Fed apologist. Well, you're a lot more than that.
I am, always.
Thanks very much. That was some great stuff. Okay.